Okay, thank you everyone. We appreciate you joining our webinar with myself, Andrew Aitken from Contango. I'm Head of Distribution, and Paul Black, the CEO of WCM Investment Management based in Laguna Beach. I think his shirt gives it away actually. So we'll be welcome today, Paul, by the way.
Andrew, thank you. I'm very grateful to be here.
We've just got a few introductory messages. One, before we begin, some brief housekeeping message from our friendly compliance team. Firstly, this is a live and interactive session, so we'd love to hear from you. If you have any questions, please send them through, and we'll ask Paul during the course of the broadcast. And just be aware that this session is being recorded. Secondly, this webinar is for educational purpose and of a general nature only. It does not constitute personal advice. Today we're going to be talking to Paul. It's very much about what the firm's known for, and that's why does culture matter. Paul will give us some insights to the beginning of the firm, where we are now, probably maybe one or two old stock stories, I suppose, but this will not be a technical based webinar. If you would like a technical process and portfolio construction type webinar, we'll do that every day of the week for you, and please organise that through me or one of our BDM team at Contango. So I just thought, first of all, I should go through the products that we'll be talking to today. In Australia, we have an ETF, WCMQ, that most clients will know. We also have an LIC, WQG, and two PDSs available for the Global Quality Growth Strategy, both an unhedged and hedged version. That's available via our website with Contango. Please feel free to reach out for us. Paul, Laguna Beach. There's a $100 billion fund manager based in Laguna Beach that some of us wouldn't have heard of before. I have, but how did that happen, Paul?
It happened like most great businesses. It happened by accident, and I say that kind of tongue-in-cheek, but it's interesting. When we look at companies that we want to own in the portfolio, we have found some of the best businesses almost happen by accident. And what we mean by that is, usually what happens in a money management firm is you kind of grind along and you build a track record. It doesn't matter where you are. The beauty of the world today, as we all know, is you don't have to be in San Francisco. It's probably an advantage not to be there. It's an advantage not to be in New York. It's an advantage not to be in Chicago or Sydney or other large cities. Nothing against Sydney. I love Sydney. It's a beautiful city. But you don't have to be in those places anymore in order to do what we do. With the world being so small because of connectivity, you can choose to live where you want to choose. And we've always been in Southern California. We've always liked being down by the beach. And it's really ironic. I mean, we're a $100 billion firm, and I would guess that most of our neighbors don't even know we exist. So we've tried intentionally, Andrew, to be below the radar. We don't do a lot of publicity. We don't do a lot of webinars. We don't do a lot of publications, and it's intentional because we just want to go about our business, and we want to pick great businesses for our clients and generate great returns. So it's a pretty intentional below the radar, but because of our size now, we're starting to get a little bit above that, and people are kind of finding out about us.
Sure. I think today there's plenty of choice in that sort of quality growth fund space. There's plenty there. Can you give us a reminder of what's different about you? How do you differ from the others that are out there? I think you've got a couple of unique features.
To me, what's interesting about what we do is how differently we think about quality. That's a great question, Andrew, because everybody in our business says the same thing about quality. A quality business to most people is a company with a high return on invested capital, very little debt, lots of free cash flow, some type of franchise or brand, something that will define and allow you to value the business 10 years down the road. And while that's true, the reality is value or quality to us is much, much more than that. And we define quality as a business that's actually able to grow its competitive advantage over time. Most people are looking for really big competitive advantages in businesses, and with all those typical qualifications for quality. Our definition of quality is owning a business where we can make the case over the next 10 years or 15 years or 20 years, the competitive advantage is likely to get stronger. Because if that's the case, obviously margins are going to grow, debt levels, if they're already debt levels, are going to go down, earnings and cash flow are going to go up. So we kind of turn the whole equation on its head by defining quality more about the competitive advantage and strengthening of that competitive advantage than we do with those absolute qualitative metrics. If quality was all about low ROIC, great profit margins, little debt, then you know what, a computer could run a portfolio. And now some people claim that, but what we have found is typically the best managers don't just get lost in the numbers, but they find the other aspects of a business that actually add value to it.
Sure. I mean, I think you were pretty well known for corporate culture there. You're perhaps known as the culture manager there in Laguna Beach. And so how did you come to realize that it was so important in looking at the stocks that you put in the portfolio, and what are some of those things that you've done to refine the ability of assessing the corporate culture in a stock?
Yeah, I mean, that's again a great question, because most companies that are in our business don't really look at the culture of the organizations they invest in. And at the end of the day, every business is about its people. And what you want to find is, you want to try to discover what the DNA of a business is from a value standpoint, and then look for alignment between that DNA and what they're trying to do on a strategy side. And again, to be quite honest, we discovered culture by accident. We discovered culture because the founder of the firm back in 1976 was pretty much a one-man show who owned all the equity, made all the money, made all the decisions. And what you had for the first 22 years in the company is a complete revolving door of talent coming in and going out, because there was never any place for that talent to express itself. And fortunately, the founder decided to retire in 1998 when we bought the company. And when we bought the company, there was only $200 million of assets under management. And we really sat down and said, boy, you know what, that was a pretty flawed culture. There were a lot of things wrong. It's really easy to attract people to this business for all the reasons. It's intellectually stimulating. It's very lucrative. It's a very fun business to be in. But keeping that talent is a lot harder. So we decided, really kind of tongue in cheek, that we needed to go 180 degrees away from what the founder did. So if the founder owned all the stock, well, we've gone from one owner in 1998 to 50 owners today. We just made 13 people this year owners of the company. So we've got over 50 owners. We also decided to make pay very transparent. I think everybody appreciates that. I mean, maybe 50 years ago, people couldn't demand transparent pay, but today you have to have it. You have to let people know what the expectations are and how they're actually going to get compensated. Very flat organizational structure. We have two core values, Andrew, in the firm, and they're very different. Our core values are fun and gratitude. We don't have, it's not integrity. It's not, hey, we're not going to steal our clients' money. Those are all kind of permission to play values. We came up with values that I think represent who we are as people. And to me, if you love what you do and you have a fun time at your job, you're going to skip to work every day. You're going to do a better job. If I'm working with my friends or people I really appreciate and adore, I'm going to do a much better job than if I was working with a bunch of people that I'm not aligned with. And then gratitude is just that sense of acknowledgement that you grow up in the West, you grow up in Australia, you grow up in America, you won the lottery. You're in the money management business, you won again, because it's an incredibly stimulating business that's very lucrative. And so gratitude should give you a level of humility. And with that humility, there should come this sense of, boy, you know what? We have a lot of responsibility here because we've been given a lot. How do we give back? Well, how we give back, we work really hard. We show up every day. And you know what we do more than anybody else in this business is we care about our people. Sounds a little corny, I know, but if you asked me to define the culture of WCM, it would be a culture of caring, because if people know you care about them, you're going to get so much more out of them from a productivity side. Now, it's an interesting culture. It's a great culture. We work really hard on it, but it's not the only culture, right? There are a lot of cultures that are much more they try to be more cost effective, like an Amazon as an example. Everything they do is to drive costs down across the board. That's not our culture. You work in a railroad company. A railroad company has a highly accountable culture. It's going to be people that are much more interested in top-down decision making. So every company has a culture, and what's important from our perspective is to identify that culture and then make sure there's some alignment between that culture's values and what they're trying to do on a strategy side. And it drives people crazy, because engineers and quants can't quantify that. What you're really doing with a culture is you're taking your 35 years of experience in the business and you're building a mosaic by talking to literally dozens and dozens of people to try to figure out what makes that business tick. For those who like to score things, it's not their bag, but I would argue that probably 80% of our excess returns comes from the work we do on culture.
Yeah, right. Yeah, I've got an image of some of the people on the webinar. I may have an image of you skipping to work as well already, Paul. So, but I will come back to culture a little bit later in regards to stock picking and how you've refined that and how that's sort of come to be. But the humility part, I just want to touch on, because I think it's kind of important. One of the things that you guys have done over time, I think you've been described as saying previously that you've made every mistake that can be made has been made, and
right.
Understanding that they can be a strength, those mistakes, if you use them properly. And how does that help you get to perhaps these two key points of broadening moats and culture over time, that humility and
Yeah, well, we had to, back in the early 2000s, we were big proponents of buying these, very wide competitive advantages, these companies that had huge competitive advantages. That's kind of what the industry teaches you. And so we were buying, really dominant companies, and we were doing a lot of discounted cash flow work on them to try to buy them at a very compelling price. We thought, hey, that's what everybody else does. Why don't we do that? Well, what it turns out is, if you're buying a company with a very strong competitive advantage, but directionally that competitive advantage is getting weaker, it doesn't matter how cheap a price you pay for that company, you're still going to have a horrible investment. And so, in the day, we were buying companies like Dell versus Apple. We were buying Yahoo instead of Google. We were buying, eBay instead of Amazon. Those are big mistakes. And, it's easy to see now, but at the time, we thought we were buying the much more competitively advantaged business for a far cheaper price. And that turned out to be exactly wrong. So the biggest lesson was really, you've got to pay attention to where the competitive advantage is likely to be 10 or 15 or 20 years from now, because if you get that part of the equation right, your valuation work that you're looking at today is going to look ludicrously cheap. It's going to look very conservative. So I think it's important in any firm to be able to learn from your mistakes. And what happens in a lot of money management firms, because you have really, you usually have highly pedigreed people that work in the business. They're extremely well compensated. They've got big egos, and it becomes difficult for that cast of characters to admit that they did something wrong. And what you find in a lot of firms is that when performance goes poor, then you start to see the true culture emerge, which is usually a culture of blame and finger pointing and infighting. And that's ultimately what destroys the ability of a money management firm to be able to generate excess returns going forward. It's interesting when I talk to allocators that allocate capital, it's stunning to me how little they ask about our culture and how much they ask about process, philosophy, sell discipline, portfolio construction. Those are all really important things, but we'd argue those are permission to play. You've got to be in that. You've got to do those things well. What matters are the people that walk out the door every single day and don't need to come back if they don't want to come back. And how do you keep them?
And we will talk about that in just a sec. So on the culture side, if we just move on to, picking stocks and type of stocks that you got in the portfolio, and if you I'm a CEO and you're coming to me and say to me, Andrew, what's your culture like? My response is probably going to be, it's great, Paul, let's move on.
Right.
Nothing to worry about here. How do you guys go in regards to asking questions, getting information out of a CEO and other stakeholders in a business, and how does it make a difference?
It is. It's an art, much more than a science. But I will tell you, to me, the most effective way to figure out a culture is to talk to former employees who left on very good terms. Look, if I wanted to, learn about Andrew, and over the last 20 or 30 years, the way that I would do that is I would talk to people that have worked with you in the past at different companies and let's say had a good relationship with you, and you guys parted on good terms. I would very quickly be able to put together a story that would illustrate what it's like to work with Andrew, or what it's like at one of your companies. So we we probably talked to 10 or 12 different former employees. Ask him a series of questions, which is what you're getting at. There are different. You can ask about corporate culture, and frankly, I do like that question, because if it's important to the person you're talking to, let's say you're talking to the C-suite, the CEO, the CFO, and they go on for 20 or 30 minutes about their corporate culture, I know it's important to them. If they just kind of flip me and they say, oh yeah, culture is important, we have these values around integrity and mission critical accomplishments, then I know that it's really not that vital a part of their firm. We also, obviously you talk to competitors, you find out who they respect the most, who they don't respect the most, vendors, anyone that sells into the organization. But I will tell you that we actually have a full-time business culture analyst that only looks at the people side of the equation of a business. Most analysts that grow up managing money or doing research on companies spend 95% of their time on the numbers. They spend 95% of their time crunching the numbers, looking at the past, and trying to extrapolate out into the future. That is a complete loser's game, because ultimately what's going to allow a company to drive the numbers to get better comes back to the people that are doing the work. And so we know we have a huge competitive advantage going forward for a lot of years to come, just because of how differently we frame the investment equation. So there's lots of ways to skin that cat, and it's a lot of hard work. I will tell you this, much like a manager better after you've owned them for a while, we know companies' cultures better after we've owned them a while, and you get better and better and better at it as time goes by. So we try to spend a lot of time on that, and but there are situations where we thought we had the culture right, and then we realized, based on how the company acted during adversity, that it actually wasn't the culture we thought it was, and we will move away from an investment idea if we missed the alignment between culture and strategy.
Yeah. Well, one of the other things about WCM, I suppose, it's at times is different. You've quite got the strength and depth of the team. It's quite a broad team. You have a lot of portfolio, 4 or 5 portfolio managers at the top. And there's no dependence on a key, stock picker or anything of that nature. Was that design? Was that just the way it worked out? How did that come to be?
We're big believers that small teams that are healthy, where there's a lot of trust and candor, typically make the best decisions. We do not have a star system. I mean, obviously, there are 5 people that are on the investment strategy group that make the decisions for this portfolio. Kurt and myself, who have been here for 30 odd years, are on that team, but we're not the people that really drive the portfolio. It's really a gentleman named Mike Trigg, Sanjay Ayer, and Pete Hunkel. They are the ones that make most of the decisions, but it is collaborative. But when I say collaborative, it's not really consensus. It's really finding businesses that have our strict criteria is so difficult that when you find one that has, an expanding moat with a culture that supports it at a decent price, there might be, we own about 35 names. There might be 50 names in the world that'll meet that criteria. So most of the time, when we find one of those ideas, we move it into the portfolio because they're so difficult to find. But I think the evidence is overwhelming. Small teams, as I said, with candor, that trust each other, that actually like each other, will do a much better job than armies of analysts. And certainly, I think they will do a much better job than one rock star portfolio manager. Typically, that becomes more of a marketing gig than it is really about running portfolios.
And if I look around at quality global growth funds around the world, the FANG stocks are going to be quite prominent in most of these portfolios. None of those stocks are in your portfolio at the moment.
They are not, and that's by design. We did sell most of the FANGs, Google, Facebook, Netflix, and even Apple several years ago, because we found it very difficult to make the case that their competitive advantage was getting stronger. It's interesting. If you ask me, hey, does Google have a massive competitive advantage? The answer is absolutely yes. Does Apple? Oh my God, their ecosystem is brilliant. The iPhone, I don't know, is it 70, 80% of their revenues? It's completely dominant. Does Amazon? I mean, Amazon dominates, e-commerce here in the US and other countries around the world. They absolutely have massive competitive advantages. But if you reframe the question around, are those competitive advantages getting stronger? Our feeling is it's hard to make that case. The delta and rate of change in the strength of their competitive advantage is much less today than it certainly was 2 or 3 or 4 years ago. So we'd rather allocate capital to opportunities where we think there's a greater chance that the competitive advantage will grow more rapidly in the future than it does today. It's interesting. A lot of those FANG names that you referenced are now being bought by so-called value managers, right? Because their multiples have compressed a lot. When a value manager starts buying, companies in technology, to me, there's a lot of things you can say about that, but one of them is the best days of the company are probably behind it, because they're trying to get it really cheaply, which means it's probably not likely to grow as fast as it has grown over the last 10 or 15 or 20 years. So we just have found better opportunities in other parts of the market with other names that are earlier in their life cycle. Here's what is Apple, a $3 trillion company right now? How much harder is it for Apple to go to $6 trillion than it is for Shopify to go from $145 billion to $300 billion? It's much harder for a $3 trillion company to do it. We'd rather own a Shopify, which we think has a much higher likelihood of growing rapidly.
Sure. And we hear the term pick and shovels used by your analysts and for some of the stocks in your portfolio. Can you give us a couple of examples and explain the term?
Sure. Picks and shovels, you know it well in your country, being big on basic materials and mining companies. Picks and shovels just refers to, in the US at least, it refers to kind of the gold rush period of time in the 1800s when everybody ran to California because they discovered gold at Sutter's Mill in Northern California. And what was determined, decades and decades later, that rather than searching for gold and with the high risk reward ratio, it was much smarter to sell picks and shovels to the miners. And it was in those days, it was much smarter to sell Levi's jeans to the literally hundreds of thousands of people that were digging for gold. It was a much easier way and a much more consistent way to make money. So that is an idea and a theme that we utilize in the portfolio. And one of the companies we love is Amphenol. Amphenol is a very boring company. It's a switch. They make switches and connectors that have everything to do with the digitalization of the world. Cars, robots, airplanes, delivery systems, anything that has technology in it needs a switch or it needs a plug to connect it. So Amphenol has this really beautiful model where they make a very simple product, but it's used by all the manufacturers of technology around the world. So you don't have to make this bet on one technology winning over another one, because all the different technologies use Amphenol's products. So to us, it's like, Amphenol is supplying the picks and the shovel to the tech industry, wherever it might be. Amphenol also happens to have one of the most brilliantly aligned cultures in the portfolio. If you ask me, I was just looking at it today, I was looking through their annual report. If you asked me today if there were a couple of companies in your portfolio you could see yourself owning for the next 15 years, kind of buy it today, don't think about it, look at it in 15 years, what's one of your favorite ideas? It would be Amphenol. Very simple business, very needed by where the world is going, and a great culture that completely gets the alignment between values and strategy. It's a terrific company. Another idea of a pick and shovel would be a West Pharmaceutical. West Pharmaceutical is a very simple company. They make stoppers for vials in biotech, in the pharma industry. They literally make stoppers and the vials. That's all they make. And when you think about that, you think about owning healthcare. How much better is it to own the vial and stopper manufacturer that sells to every single biologics and every single pharmaceutical company in the world, right? When you buy a pharmaceutical or a biotech company, you're making a bet that they're gonna win the discovery game. When you buy a Western pharmaceutical, you're literally betting that the whole industry is going to grow, and you're going to be a participant in that, in a very, very high margin, simple, low cost product that everybody needs to access. So the picks and shovel theme is one you're going to see a lot throughout our portfolio. You could actually even argue that Shopify, one of our bigger holdings in the portfolio that we've talked a lot about, is a picks and shovel play, right? Shopify basically is disrupting Amazon's third-party marketplace by creating a platform where people can sell anything they want on the web and have a turnkey operation. So Shopify is a pick and shovel play on the growth of e-commerce across the globe. It's brilliant, absolutely brilliant. And that's not going to go away soon. And they have a dominant position in that.
Well, I've got a couple of questions coming through from the crowd, and I'll pick a few out. But the first one, I think, from a current investor who we know well, and just their point of the PE of this portfolio is well above market, well above market. How do you justify that? How does that work?
Yeah, what's important to know about PE ratios is they're a snapshot in time. They're just taking a snapshot at this moment in time, and what you really need to look at, and what's much more important, and what we're concerned with, is what is the PE ratio likely to be 5 years from now. It's a much better way to think about the evolution of a business and a company. Let me give you a quick example. We used to own in the portfolio. We actually in 2007 bought Baidu, which is the big search engine company out of China. And when we bought it, it was selling at 95 times trailing earnings. So everybody, of course, says, oh my gosh, optically, this looks incredibly expensive. They earned about $0.05 a share. And our thesis on Baidu was, that usually search in a country is a winner-take-all market. Baidu had 50% market share at the time. We thought there was a high probability that they were going to get up to 85% market share. So if we modeled that out, snapshot in time looks expensive, but if you model out 85% market share over a 5-year period of time versus 50, and then you back into an earnings model, what you actually found is when we sold Baidu in 2012, it was selling, in hindsight, at 2 times forward 5-year earnings, because their earnings went from $0.05 a share to $4.50 in 5 years. So again, we're buying businesses that are improving, that are getting better. And optically, they can look expensive, but there's so many studies that have been done. You can pay a very high multiple for a business if it's continuing to take market share and growing. If it's not, then it's a fool's game. But if you're right about the growth of the competitive advantage, in most cases, I'd say 85% of the time, the valuation snapshot you take today is going to look ludicrously cheap 5 years from now. So it's a good question, but I would say the reason we have an advantage is most people in our business worship at the notion of a snapshot in time PE ratio. And as long as they do that, we're going to have a massive advantage over them because they're not thinking about the business a decade or two from now. Look, investing is all about time is your friend in investing. It's never made sense to bet against great high quality growth stocks that have expanding moats. It's never made sense to do that. And time is your friend. If you've got a 1 month or 3 month time horizon, then don't invest in stocks. But if you have a 5, 10, 15, 20-year time horizon, you are going to be richly rewarded.
And the other questions coming through, I'm going to ask the question, we spoke about this before. We're getting a lot of questions about outlook and macro outlooks and things like that. I think it's worthwhile. I think you asked me not to ask any silly questions, but you obviously didn't do your research beforehand. Just our view on being bottom up stock picker and our ability to actually have any real insights on a macro view.
Yeah, you know, I'll tell you what. Our feeling on macro views is, look, if you're I'm still stunned that people listen to economists or listen to people with macro views, because inevitably they're wrong. If you took 100 economists in the U.S. in their predictions of where interest rates would be today from 12 months ago or 3 years ago, I'd say, let's say 100% of them were wrong by a large factor. And so the key about the macro is if you're going to make macro predictions, you better make a lot of them because you're bound to get one of them right. Now, having said that, I will tell you, the macro does matter in emerging economies. It really does matter. In more of the developed world, you want to own businesses that can dominate in spite of what's going on with interest rates or inflation or the valuation of the currency. And I'll give you a quick story on why it's more important in third world countries. I shouldn't say that, it's really emerging economies. But in 2015, Brazil was in a tailspin. And we do a lot of research trips. All of our people go all over the globe all the time when we're free to travel. But in 2015, we went to Brazil because nobody wanted to own Brazil. Nobody wanted to own them. The real was down 50%. The market was down 50%. Inflation was probably at 20%. Corruption, as is pretty usual in an emerging economy, was very, very high. There was absolutely no reason to invest in Brazil. Well, when we went down there, we met with 12 different companies. And probably out of those 12, 10 of them just kept complaining about how poor the macro environment was, how it's tough because of inflation, it's tough because of the corruption. And our thoughts were, boy, why would we invest in those companies that are blaming their ill fortune on bigger outside events? There were two companies. One of them was Mercado Libre, which is the Amazon of Latin America. When we met with them, they said, look, we're going to manage right through this. Our business model is so powerful, and the uptake in what we do in the e-commerce space and certainly in payments is, that runway is so long that we're going to be able to absolutely dominate this market when everything turns here in Brazil. There was another company called Rea Drogasil, which was a pharmaceutical company, much like some of the big pharmaceutical companies in the U.S. or in Australia, lots of locations, lots of chains. They said the same thing. They said that we don't care about the macro. We're still going to execute our business plan in spite of what's going on. And we made investments in both of them that have been just highly and wildly successful because nobody else wanted to own them. So macro can impact you in the short term, but you can usually use it when it's negative as an opportunity to buy a great business at a very great price. So we try to use it a little bit different. Never make predictions, but take dislocations in markets around the world because of macro and then use that as an opportunity to invest.
We're going to explore that emerging markets sort of theme because we will talk a little bit later in regards to some of the products that you've currently got under management there in the States that we'll be bringing down to Australia. But when you're in Brazil or China or wherever you are looking at a company, how do you sort of compare a US company's culture versus a Brazilian company's culture, or is it not a relative game in that sense? It's just how does that culture support that company's expanding
It's
moat?
It's the same. You want to see similarities. We look for that alignment. It's interesting. because where we have a hard time is in Japan. We really have a hard time finding, high quality businesses, which we define as those with expanding moats, with cultures that support it, because the cultural norms in Japan are not necessarily conducive to creating that alignment. So we've had the most. We're light in Japan. It's not intentional. We just can't find the kind of cultures that we want to own. Yeah, you're correct that every part of the world is a little bit different, but Japan is hard because they still have a big top-down hierarchical structure with a lot of cross ownership of shares between businesses, and we just don't want to be in that world. And while we do own Keyence in the portfolio, which is basically a sensor maker for automation, we don't find a lot in Japan. China, we own a couple of names, not a lot. And then we own a couple of names in Latin America, but they're hard to find. You're 100% right, and that's why we spend time. Funny story. We went to Japan. We went to China. Oh my gosh, 6 years ago. We owned a company called Sunart. No, not Souls. We owned Sunart, and we owned a company that made crackers, and we went to the headquarters. All they made and they sold through mom and pop shops. They made crackers and instant noodles, which is a great market in China. But when we went to the headquarters, the first thing we saw was a model of the private plane of the owner with a picture book you could go through. And we walked up the stairs, and there was and I'm not kidding, we went up the stairs, and at the top of the stairs, there was a 30-foot portrait of his Chihuahua. And then we went into and we went, that's kind of odd. And then we went into the conference room, and we talked to, the CEO and the CFO and IR, and we asked them. I said, look, modern retailing is coming to China. The Walmarts of the world and the Carrefours, and it's modern retailing is coming down the pipe. How are you going to compete in that space? Because you're going to have to compress your margins in order to compete. And they said, we're not going to do it. We're going to stay in that little corner store on every corner and every street in China, and we have no interest in doing what's going to be the future of China. And we literally walked out of that meeting that day and called up the office and sold our position. So it's important. You can catch a lot by being there in person. That's why this the fact that we're not traveling in COVID, it does does it affect us a little bit? We do a lot of Zoom calls, but there's nothing like sitting across the table when you ask somebody a question. There's nothing like it, because you can pick up body language and other aspects of communication that are really almost more important.
Well, you might have had a hard time in Japan at times, but you're not going to have a hard time in Australia, because we know you're going to be coming down here in sometime, hopefully in the first half of next year. So we're looking forward to it, and we'll be holding a number of and inviting people to meet with the team in their offices if they like. But part of that will be the introduction to a few of your products here in Australia. In particular, we'll be opening the Mid-Cap Growth Fund. We'll have a fair exposure to emerging markets.
Yes.
Can you please speak a little bit about that fund? It'll be opened as an ETF, by the way, here, a dual listed structure, ETF and PDS.
Yeah.
And can you speak about the portfolio manager, Greg Ice?
I can. It's interesting you bring that up, because I have obviously a lot of options. I invest all of my personal wealth in the strategies that we run here. But I actually, I have a couple of trusts for my kids, and I put both my kids' trusts in the mid-cap, kind of all cap, small caps, mid-cap product, because I really do believe that it has the best opportunity to create a lot of outperformance, because it's not constrained by capitalization. We can go down the cap, we can go up the cap, we can go across the board. So it's really kind of a best ideas portfolio. And it's performed brilliantly well, and I expect it to continue to do that. Greg Ice is one of our senior portfolio managers. He's been running our small cap international growth strategy for over 7 years, which we closed to new investors as of about 2 months ago at $2 billion of total assets. Had no track record 7 years when we launched it, and we closed it just recently. He's a brilliant stock picker. He's passionate about it. He lives for this business. He's a hard worker, and he takes what we do around corporate culture and competitive advantages and just enhances it in his own way. But I actually think it's one of the more exciting portfolios we have, you know, in the firm, in terms of looking at, there are more inefficiencies in the smaller cap names than there are certainly in large. And so it's even easier to find those kinds of companies we want to own.
Yeah, well, we look forward to your team coming down to join us. We look forward to Greg Ice coming down also, hopefully, and that mid-cap fund being available. We know there's emerging markets fund and other funds that we'll be bringing down over the course of the journey. But we've enjoyed our journey so far, and today, thank you for making it. It's very hard to get you sometimes, Paul. I know how busy you are with such a big firm to look after, but we appreciate your time. I know not to ask after the Chinese noodles firm whether I can have a ride in the WCM private jet. So that's off the cards. But nevertheless, thank you for your time. We appreciate it.
Thank you, Andrew. It's a pleasure, and really thank everybody on the call that has trusted us with their money. We take it very seriously, and we work hard to generate excess returns for everyone. It's very gratifying to actually exceed the expectations of your clients across the board. And I will tell you, you know, fun and gratitude, we're grateful for the clients. It's a lot of fun to outperform, and that's what we try to do every day.
Well done. Thanks, Paul.
Thank you. Take care.
Bye.